In chapter 10, exercise 3 is the one that I think you will have a homework problem. So let's go to exercise 3. So it says, sorry. It says Clothing Frontiers began operation on January 1st and engages in the following transactions during the year related to the stockholders' equity. January 1st, company issued 700 shares of common stock for $50 per share. On April 1st, issued 110 additional shares of common stock for $54 per share. Required to record the transaction, assuming no par common stock. In second requirement, record the transactions assuming company has either $1 par value or $1 stated value common stock. So requirement number 1, there is no par value. If there is no par value, the journal entry is very easy actually. So we just debit cash for 700 shares times 50. That's $35,000. And common stock will be credited to record the issue of common stock. In April 1st, we issued additional 110 shares. That's times 54 based on that market price of the day. So they issued $54 times 110. That's $5,940 of common stock. Cash debit, common stock credit. This is very easy. However, if it is a par value involved, then you have to separate the common stock based on the par value. Any additional cash that you raise by issuing common stock goes in additional paid in capital dash common stock. So here is debit, cash $35,000, same as above. But common stock goes just based on $1 par value. Sorry, that's $1 par value times 700 shares. That's $700. That's all it goes in common stock. Additional cash that you raise goes in additional paid in capital dash common stock. That's the difference. Okay, 34,300 credit for the difference. And in April 1st, they issue another 110 shares at $54 per share this time. So $54 times 110, that's $5,940. Common stock is $1 par value, so that's what it goes in the common stock, $110. The difference goes in additional paid in capital dash common stock. Par value or stated value literally is the same meaning. In some companies, they call it par value. In some corporations, they call it the stated value. Either way is the same thing. Okay. So exercise, let's do at least 2 more problems. Okay, exercise 4. In exercise 4, it says Nathan's has 2,000 shares of 5%, $100 par value preferred stock. 5%, that means this preferred stock will provide a dividend of 5% of par value to the shareholders. And if there is a preferred stock, then the common stock has the priority. Preferred stock has the priority to receive the dividend first, and then if anything left goes to common stock. So preferred stockholders have priority to receive dividend, priority to receive any cash left after company's bankruptcy, all those things that needs to be distributed. Preferred stock has priority compared to common stock. Okay, so the company has 2,000 shares of preferred stock, 5%. All remaining shares are common stock. The company was not able to pay dividends in 2020, but plans to pay dividend in 2021 for $22,000. Assuming the preferred stock is cumulative. Cumulative, that means preferred stock will get the dividend, and if for year one they didn't get any dividend, in year two they get dividend for year one and year two, so it's not going to get lost. However, if it is non-cumulative preferred stock and they didn't get any dividend in year one, then it's lost. In year two, as soon as dividend is declared, all they gotta get is just year two dividend. That's it. Year one is gone. History. So cumulative preferred stock is much better than non-cumulative preferred stock. So assuming that preferred stock is cumulative, how much of the $22,000 dividend will be paid to preferred stockholders and how much will be paid to common stockholders? Now assume if it is non-cumulative, then what? So this is an awesome question, an awesome example. So let's look at the solution. So if it is cumulative, then the preferred stock is already in arrears for 2020. And how much is it? It's 2,000 shares times 5%, that 5% of par value. So that's what the dividend will be for preferred stock. 2,000 shares times 5% times $100 par value. That's $10,000. So the first $10,000 goes for dividend in arrears because in 2020 they didn't get paid. So it's in arrears. They have to cover that. And then they have to cover the 2021 dividend, which is due right now. So that's another 10,000, right? So what is left? The remaining $2,000 out of declared $22,000 dividend will go to common stock. So common stock will get only a tiny portion of that dividend that has been declared. However, if it is non-cumulative, then preferred dividend in arrears of 2020 is history, is gone, lost. Sorry, you don't get anything. But the shareholders for 2021 will get that dividend that they deserve because it has been declared, so they're going to get it. So that way, $12,000 will be the remaining leftover balance, and that goes to common stock, assuming it's non-cumulative preferred stock in requirement number 2. Any question, please let me know. Okay. Okay, so let's do at least one more problem. Okay. How about if I do number 5 for you? Okay, so the company has the following transactions during the year related to stockholders' equity. In February 1st, they issued 6,000 shares of no par common stock for $16 per share. 6,000 no par. And remember, no par common stock, it's a very easy journal entry, right? So let's look at that. Okay. In exercise 5, the first thing is issuing 6,000 shares, no par, $16 per share, common stock. Okay, 6,000 shares, no par. Yeah, 6,000 shares, no par, $16 per share. So 6,000 shares times $16, that's $96,000. And because it's no par, so every dollar that they raise goes in the common stock, no problem. So that's a very easy journal entry. In May 15, they issue preferred stock above par. So the par is $10, and they issued for $13 preferred stock. So it's above par, 700 shares. So 700 shares times $13, that will be $9,100, right? However, the par is $10. So that's all they can go in the par. So 700 shares times $10 par value, that's only 7,000. The difference goes in $2,100 difference, goes in additional paid in capital dash preferred stock, additional paid in capital dash preferred stock. That's where the $2,100 go. Okay. In problem October 1st, it says they declare a cash dividend of $1.25 per share to all stockholders of record, both common and preferred, on October 15. So here we have 6,000 shares and another 700 shares, and everyone gets $1.25, so 6,700. Okay, keep that in mind here. So 6,700 shares times $1.25. So the dividend will be debited to record the dividend that has been declared. And because it's not paid yet, it's just declared, so we record that as dividend payable. It will be paid maybe next month or so, but for now we call it dividend payable. That's a credit. In October 15 is date of record. Date of record, it's a date that the company will figure out who owes how many shares, and every one of those shareholders will be, in matter of weeks, get paid for the dividend. So there is nothing right now to record. It's just matter of finding out who has how many shares. That's it. But 2 weeks after that, in October 31st, the company is paying the dividend that has been declared already. So that's a journal entry, because they're gonna pay for that. So here is October 31st, dividend payable is $1.25 times 6,700 shares, that $8,375, and cash will be credited. Okay. Let's see what else we have. Okay, let's do one more, which is number 6, is also part of your homework problem. Okay, let's do number 6 also. So here is number 6 saying, okay, Finishing Touches has 2 classes of stock authorized, 8%, $10 par value preferred stock, and $1 par value common stock. The following transactions affect the stockholders' equity during 2021, its first year of operation. Okay, so this is year 1, operation on January 2nd. They issued 100,000 shares of common stock for $35 per share. 100,000 at 35. and that's common stock, and common stock is $1 par value. Okay, keep that in mind, and here will be the solution. The solution is 100,000 shares at $35, but we have a common stock with the par value of $1. So we cannot put more than $1 in the common stock. So cash will be debited to recognize that. But common stock will be only recognized based on par value, which is $1, 100,000 shares. The remaining will be a plugged in difference. The difference between the other two entries. And that's $3.4 million. And that goes in additional paid in capital dash common stock. Dash common stock is important. It's not showing in here, but it's very important. Okay. In February 6th, the company issued 3,000 shares of 8% preferred stock for $11 per share. 8% preferred stock, $11. 3,000 shares times 11, and the preferred stock has $10 par. Okay, that's max can go in the preferred stock. So keep that in mind. Here we go. 3,000 shares times 11, that's $33,000. However, the preferred stock par is $10. So $10 times 3,000 shares, that's the maximum you can put in the preferred stock. The difference, it's a plug it in, which is 33,000 minus 30,000, and that's an additional paid in capital dash preferred stock. Okay, this part is also cool. In September 10th, the company purchases 11,000 shares of its own common stock from market. If the company buys its own common stock from market, it becomes all of a sudden treasury stock, which the company needs to keep a record. How many treasury stock they have, when did they purchase it, and how much did they pay for it. So they paid $40 on September 10th, 11,000 shares, and the journal entry is treasury stock. That's a debit. That's a contra account for equity. That means if you have more treasury stock, that means your equity will go down. If you have more common stock or preferred stock, your equity goes up. But if you have treasury stock, then treasury stock will decrease your equity. So treasury stock will be debited for $440,000, purchased at $40 each at the specific date of September 10th, and that's a cash credit paid for that $440,000. Okay. However, in December 15, a few months later, the company resells 5,500 shares of treasury stock at a fantastic price of 45. So they bought it for 40. Now they are selling for 45. That's easy way to make money, right? So 45 times 5,500. And the answer is 5,500 times 45. That's $247,500 cash that they received. And the treasury stock, remember, they bought it for $40. That's all you can reduce from treasury stock. So 5,500 shares times $40. So the treasury stock will be credited by $220,000. The difference, $27,500, will go in additional paid in capital dash treasury stock. Additional paid in capital dash treasury stock. So it's very important to have that dash treasury stock separate T account so you can easily identify where that additional paid in capital is coming from. Or is it coming from treasury stock? Is it coming from preferred stock or common stock? Okay. Now, one thing that I like you to remember, in case the company sells the difference, the other 5,500 shares, and the company sells it, let's say, with lower price than purchase price. Let's say instead of selling 40, selling for lower than 40, the loss comes out from additional paid in capital dash treasury stock. So here, additional paid in capital dash treasury stock here goes up by 27,500. But if in future there is any loss from sale of treasury stock, will come out of this account. Okay. Okay, so that's exercise 6. So I did few of those for you. You have few more to go. So definitely study the PowerPoint I provided to you, study the book. There are good examples in the book. If there is any question, obviously, let me know and I will try to answer it. Okay. Have a good day and see you next week to cover the last chapter, which is chapter 11. And you have also a PowerPoint group project due soon. So make sure you are working with your group. If there is any issue, let me know. Okay. Have a good day. Bye-bye.